Have you ever wondered why you're not getting much tax refunds? Most Canadians are overpaying their taxes every year, but it's 100% legal to avoid it if you just know the right strategies. After working 12 years as a financial planner and hundreds of hours of studying on this topic, here are the top 6 things to know in order to pay less taxes. Number 1 is how the government taxes you. A friend once asked me if he should take a pay raise because he was worried that it will bump him to a higher tax bracket and he'll end up paying more taxes and less money for himself. This is the biggest misconception people have regarding taxes. In Canada, we have a progressive tax system with marginal tax rates. Basically, the higher income you earn, the higher your tax rate will be. But the higher tax rate doesn't apply to your entire income. Let me explain. For example, if you're earning 70k in BC, you'll fall in the 28% tax bracket. But that doesn't mean your entire 70k is going to be taxed at 28%. The way to understand this is imagine each tax bracket is its own piggy bank. And as you're earning income, you fill up each of the piggy bank one by one until you eventually run out of income to fill up an entire piggy bank. Now the first piggy bank is going to represent the first tax bracket, and all the income you put inside this piggy bank, it's going to be taxed at 20%. Now when it comes to the second bracket, you're going to be taxed at 22%, and in the third bracket, you're going to be taxed at 28%. So when you're earning 70k of income, you'll be paying $9,600 for the income in the first bracket, $1,799 for the income in the second bracket, and $3,985 for the income in the third bracket. So if we add up the total, you'll end up paying $15,400 in taxes. But this is before we claim any tax deductions or tax credits that we'll be talking about later in this video. But the one tax credit that all Canadians are eligible for is the basic personal amount. And for 2024, this will give us a tax break of $2,992. So you end up with $12,400 in taxes. But you might be wondering, if I'm paying $12,000 in taxes, how come I'm still getting a tax refund every year? Some people think it's free money from the government, but that's actually not true. The way the tax process works is that for every paycheck that you receive, your HR already calculated how much money you're supposed to pay for taxes, and then they take that portion away out of your salary and prepay that to the government. And what happens here is the HR usually takes more than enough so that there's a little bit more extra just to be safe. Then in the end, when you file your taxes, then you realize that you actually paid too much to the government, and then you'll receive that money back in the form of a tax refund. This is the real reason why people are getting a tax refund, and you should know that it's your hard-earned money and not just free money from the government. And if you're working multiple jobs, then you'll often run into an issue where you start owing taxes instead of receiving a tax refund. This is because every employer assumes that the employee has the basic personal amount that they haven't claimed yet. So when you have 2 jobs, the second employer likely doesn't know that you have another job, and so they end up taking less taxes than you're supposed to. Surprise, surprise, you end up owing money when you file your taxes. And of course, if you have other income from investments or from side hustles, then you're likely going to end up owing taxes because no taxes were prepaid for any of these income. So how can we pay less taxes then? Well, the secret is that you could have 100k of salary, but end up with only 70k of taxable income by applying the tax strategies that I'm about to share with you. It's a lot easier than you think, but you do need to be strategic about it. And that leads us to the second thing you need to know about is registered accounts. These accounts can be used to lower our taxable income, so we end up paying less taxes and getting a bigger tax refund. And there are several types of these registered accounts. First, there is the work or group RRSP. As the name suggests, this is an account that's offered by your employer, so depending on your employer, you may or may not have it. So be sure to check with yours to see if it's available. And a work RSP is where you can put money inside and you can use it to save or invest, and the amount you contribute to this account will give you a tax deduction, which lowers your taxable income by the same amount. So for example, if you have $100,000 salary and you contribute 10%, of your income into a group RSP, this means that you'll contribute $10,000 in this, and because this $10,000 will become a tax deduction for us, so our taxable income will actually be lowered from $100,000 to $90,000. And this will end up giving us an extra $2,900 in tax refunds. Another way to look at this is that the income that we put inside an RSP account is actually not going to be taxed. But that's not even the best part. The best part is that most employers offer matching when you save money into this account. Meaning, for every dollar that you put into this account, your employer will also put in $1. Now this is free money from your employer. So just by putting money in this account, you're basically doubling your money without even doing any investments. This is hands down the best account you can use to build up your wealth. Now a note here though is that because it is an RSP, there are some rules you need to follow when it comes to withdrawing money out of it. First of all, you can withdraw your RSP money out anytime you want. But any amount you withdraw out from it, it will become your taxable income for that year. There are two exceptions to this rule. Number one is you're a first-time home buyer and you're using the funds to buy your first home. In this case, you can withdraw up to $60,000 tax-free in the year you purchase your home. The second exception is if you go study full-time. And in this case, you can withdraw up to $20,000 tax-free. But if you withdraw your money tax-free under these two conditions, you do need to gradually refill that RSP back up over a period of 15 or 10 years respectively. Another type of registered account is the personal RSP. This type of account works the same way as your RSP in terms of tax deduction and also the withdrawal rules. The only difference is personal RSPs are accounts that you can open with any bank or financial institution by yourself. And you can have as many RSP accounts as you want, as long as you stay within the contribution limit. The limit is 18% of your last year's income, and for any unused contribution room, it will be carried forward indefinitely for your future use. The third type of account we could use is the FHSA or First Home Savings Account. This account is mainly for people to save money towards their first home and is only available for first-time home buyers. Now, if you're wondering if you're considered a first-time home buyer, as long as you did not live in a home that's owned by either you or your spouse or common-law partner in the previous 4 calendar years, then you're considered a first-time home buyer. This also means that if you've purchased a property and have just been renting it out and never lived in it yourself, then you are also considered a first-time home buyer and you're eligible to have this account. The FHSA works the same way as the RSP in terms of giving you a tax deduction, but the best part about this is there's no limit to how much you can withdraw out tax-free. And there's also no need to refill this account back up after withdrawing. Another account you should know is the TFSA or the tax-free savings account. Now, it doesn't exactly lower your taxable income, so we really consider this as more of an honorable mention. But why we should also know about this account is because this account allows us to hold investment inside and grow it tax-free. And it's also a much more flexible account compared to the RSP or the FHSA because you can withdraw money out from this account anytime for any purpose tax-free. We mentioned earlier that if you're doing side hustles, then you might end up owing more taxes. But there are some tax advantages that you should know about this as well. Whenever you're doing freelance or contract work, you are considered to be running a self-employed business in the government's eyes. And if you're not sure if you're considered self-employed, the easiest way to tell is to see if you will receive a T4 for the income that you earned. If you didn't receive any tax slips or if you only received a T4A, then chances are you were doing independent contract work, so you're considered self-employed. Now, why it's so important to make this distinction is because there are some tax advantages, but there's also some disadvantages to being a self-employed. Here's the main difference. Number one is any expense that can potentially help you earn more money in your business, you can claim that as a business expense. This is why we sometimes hear people say that they're writing off their income, because they're essentially taking their business expense and claiming it as a tax deduction. Now, these types of expenses can include operating expenses such as advertising, meals with clients, and office expenses, as well as any equipment that you use, for example, your laptop, your camera, or even software subscriptions. And if you need to drive around for the work or to meet clients, you can also claim the vehicle expenses, including gas, maintenance, insurance, and even lease payments. For example, if you earn a 100K income and you bought $20,000 worth of business expenses, then your taxable income will become $80,000. The second difference is home office expenses. Employees can claim home office expenses as well, as long as they have a signed 2200 form by their employer. But the list of eligible expenses are much more limited compared to someone who's self-employed. The biggest difference is, as a self-employed, you can claim mortgage interest, property taxes, home insurance, whereas employees can't. These are significant costs for a homeowner, and just by being self-employed and working from home, you can claim a portion of those expenses to write off your income. The third difference is EI premiums. For employees, EI premiums are about $1,000 a year, but for self-employed, EI becomes optional. So you could potentially save $1,000, but of course that means giving up the maternity or the sickness benefits. And the fourth difference is CPP. As an employee, you pay 5.95% of your income as a CPP, and your employer will pay another 5.95% to the government for you. But as a self-employed, you're basically considered as your own employer. So this means that you're actually paying double the amount. So you're paying 11.9% of CPP instead. Next is tax deductions and credits. There are countless deductions and credits available, but here are the most commonly used ones. First is the child care expense deduction, and this is for families where both spouses are working and they need to send their kid to a daycare. The lower income spouse gets to claim up to $8,000 of deduction for the expenses paid for any children under age 7, or up to $5,000 if their kid is between 7 to 16 years old. The second deduction is when you can turn your bad debts into good debts, which means that you're turning your interest that's normally not tax deductible into something that can become tax deductible. This usually requires more advanced planning or strategies like leverage investing, and is normally used by higher income earners. For example, if someone has a $10,000 debt and they have a $10,000 investment, what he can do is he can sell this investment and use the money to pay off this debt. Then he can use a personal line of credit or a home equity line of credit and take out $10,000 to put it back into his investments. By doing this, he still has $10,000 of investment, and he still owes $10,000, but now instead of the original debt, he now owes $10,000 to a personal line of credit or a home equity line of credit. But now the difference is the interest expense that he needs to pay is now tax deductible because he effectively borrowed money to invest. And so he can claim a tax deduction under carrying charges on line 22,100. I do want to point out though that this strategy is not for everyone because there's a number of factors that you need to consider, such as tax implications, investment returns, time horizon, also the risk tolerance, and interest rates. Some people further extend this to something called the Smith maneuver in order to make their mortgage payments become tax deductible as well. Next is the medical expense tax credit. Now we can only claim medical expenses if the total exceeds 3% of our net income. Now for people with spouses, you can claim all the medical expense under one person. So this way it's easier to exceed that 3% of income. Most people just add up all the expenses they had from January 1st to December 31st, but you don't have to use this period. The government actually allows us to use any 12-month period that's ending in the same tax year. So for example, in your 2024 tax return, you could claim medical expenses from February 2023 to February 2024, as long as you haven't claimed the expenses in the previous year's tax return. When this might be useful is when there's a year where you had a lot of medical expenses, but not a lot of income in that year. In that case, instead of wasting the medical expense and not getting any tax savings, you can save it up for the next year to see if you can get a bigger tax return. Another one is the donations tax credit. For donations, you can also combine both spouses' donations and claim it under one person. And this is beneficial because you actually get more tax savings when your donation amount total is over $200. So if your total donation amount is less than $200 in a year, then you might want to consider saving it and claiming it in a future year so that you add up to a total that's over $200. Aside from using the deductions and tax credits, there's also other ways that you can split income to your spouse or other family members. For example, you could use the childcare expense deduction that we mentioned earlier and use that to split income to your other family members. For example, you can consider asking the grandparents to help babysit, and this way you can pay them a childcare fee, then claim it as a tax deduction. On the other hand, the family member who's helping you babysit will need to report that as part of their income. And this type of income would be considered a self-employed income as well. So you could also make use of the business expenses that we mentioned earlier. And depending on their income, they might also qualify for the Canada Workers Benefit. That's going to be an additional $1,400 in tax refunds. The second way to split income is by using a spousal RRSP account. This type of RSP account is for families where one spouse is earning significantly higher income than the other spouse. So what happens here is the higher income spouse will use their own contribution room, and they would actually contribute into a spousal RSP account that's basically owned by the lower income spouse. Now, when you do it this way, the higher income spouse gets to use the tax deduction, so you can save a lot more taxes, while the money is gonna stay inside an account that's under the spouse's name. So this way, it will help you with future withdrawals, because the future withdrawals will also become taxable income, but instead of it being under the higher income spouse's name, now the RSP income is going to be part of the lower income spouse. So in the end, you actually reduce a lot more taxes for the family. The third income strategy is something called the spousal loan. This is a more advanced tax strategy that's more for higher income families. And this is where the higher income spouse would basically loan the money to the lower income spouse, and there will be some interest rate at the CRA prescribed rates. Then your spouse would then take the funds and use it to invest. Similar to the spousal RSP, by doing it this way, all the future investment income will be taxed under the lower income spouse's name. Now with this strategy, the government is quite strict, so you need to make sure the lower income spouse actually pays the annual interest to the higher income spouse. Otherwise, if you forget to do that in that year, then the income earned from the investments will then be attributed back to the higher income spouse. So instead of it being taxed at a lower rate, now it's going to go back to being taxed at a higher rate. As for the higher income spouse, they do need to report the annual interest as taxable income as well. If you're considering this strategy, you should consider working with a tax lawyer. And also be mindful that there's going to be ongoing costs such as legal fees or accounting fees to maintain the spousal loan. This strategy is not as attractive as it used to be, because it used to be 1 to 2% prescribed rate, but now it's actually at 6%. But it's still worth considering if you can expect to get a higher investment return compared to the prescribed rate. Also, interest rates have begun dropping as well, so you might want to keep this in mind if you're in the position to take advantage of this. Now, when it comes to real estate, a lot of people like to own multiple properties, and there's actually a good reason why. It's because there are many tax benefits when you own a real estate. For one, when you own a property and you live in it yourself, you do qualify for the principal residence exemption, which basically means the home that you live in is going to be tax-free when you sell it in the future. With our home being the biggest asset that we likely will have, having it tax-free will make a huge impact to your overall wealth. Also, when it comes to paying property taxes with your principal residence, there are some provinces like BC or Ontario that offer government programs that let you defer your property taxes. So people who are eligible can actually stop paying their property taxes and pay it later with a low annual interest rate. You can defer the taxes until you eventually sell the property or when you do a refinance on the property. Different provinces have different criteria, but in BC, if you have a child that's under 18 years old, or if you're 55 years old, then you qualify for this program. The idea is that you can free up the cash flow. So instead of using that money to pay the government, you can now use the money for multiple things, right? You can either use it to pay for living expenses, or you can use it to build up your investment savings, or you can contribute into your RSP for additional tax savings. Or if you have a child, you can use the money to contribute into RESP to get the 20% grant. Or you can use it to enhance your estate plan by using the money to buy a life insurance policy. And the tax benefits don't just stop at the principal residence. When you own a property and you're renting it out, we're able to generate rental income, and usually the rental income is going to be taxable. Now that doesn't sound too good, right? Well, yes, but not really. The reason is because you can actually use rental expenses to offset the rental income that you make. So for example, if you own a property and you're renting it out for $2,500 a month, this means in a year you'll earn $30,000 in total. And imagine if you have a full-time job and you add another $30K on top, that's going to be a lot of taxes. But according to the 50-page publication by the CRA, a lot of things can be claimed as a rental expense to write off your rental income. For example, you can write off your operating expenses, home insurance, property taxes, repairs, mortgage interest, and even depreciation. And because of this, now it becomes a lot more attractive. Let's say your rental expenses cost about 20% of the rental income that you make. So in our example with 30K of rental income, your expense is going to be 6K. Then you can also deduct the mortgage interest. But keep in mind, you need to separate out the mortgage payment to see which part is the interest and which part is the principal, because we can only deduct the interest portion of the mortgage payments. And let's say the mortgage interest comes out to $20,000 in a year. So that means we can take away $6,000 and another $20,000 out from our 30K rental income. So in the end, we'll only have $4,000 of taxable rental income. But that's not even all. You can also claim depreciation on your furnitures or appliances, and even the rental property itself. And when you claim depreciation, you can actually choose how much you want to depreciate by. For example, if your rental expenses already reduces your rental income to zero, then there's probably no point for you to use additional depreciation. In that case, you can actually choose to not depreciate your property on paper and save it for future years, and you can use that to reduce your income down the road. However, there are a few nuances to this, especially when it comes to depreciating the rental property itself. While claiming depreciation does give you a lot of tax savings every year, it might also bump up your taxable income by a huge amount in the year that you sell your property. This is because there's something called the CCA recapture. And this happens when you sell an asset for more than its undepreciated capital cost, which is the remaining value of the asset on paper after depreciation. So for example, let's say you purchased a property for $600,000 and you sold the property 5 years later for $700,000, then you would have a capital gain of $100,000. And since the inclusion rate for capital gains is 50%, that means we would take 100K of capital gain times 50%, that will give us the taxable capital gain amount of 50K. And this will be the amount that's going to be added onto our taxable income. But let's compare what happens if you chose to claim CCA or depreciation on your rental property. Let's say you claimed 100K on depreciation for your property. Then the undepreciated capital cost would be 600K minus 100K, so it will equal 500K. Remember, we sold the property for 700K, right? So when the UCC amount is less than how much you sold it for, then this is where a CCA recapture happens. And that means the difference between 700K to 500K, this $200,000 difference is going to be added onto your taxable income. And the worst part is this will be considered income and not capital gains. So it means you would need to add 200K of taxable income for that year. Now this might sound horrible, so you might be wondering, how come people still choose to claim CCA then? Well, there's definitely a lot of people who claim CCA because they just don't know the full consequence of claiming depreciation on the rental property. All they're focusing on is probably the potential tax savings that they were going to get every single year. But this doesn't mean that this strategy is all that bad. It just requires proper calculations and planning to make sure that it's worthwhile, because sometimes saving a chunk of taxes every year and using those tax savings to invest may actually get you a lot more ahead, even if it means you need to pay a bigger chunk of taxes later on down the road. Generally speaking, the longer you plan to hold on to your property before selling, the more attractive claiming CCA will be, because you would have more time to invest your tax savings and try to get ahead before the CCA recapture happens. Another consideration is that claiming CCA actually takes away your ability to use the change of use elections. for deferring capital gains. A lot of people don't know this, but if you ever decide to move back into your rental property, it is considered a change of use, and in the CRA's eyes, they would consider you to have sold the property on the day that you move back in and repurchase the property on the same day. Now that might not sound like much, but what it means is when this happens, the CRA would be expecting you to pay a capital gains tax on any appreciation that has happened for your property. When you haven't even sold the property yet, you simply just move back into a property that you've been renting out and you will be charged capital gains tax. The way around this is to make a change of use election. But the danger of claiming CCA on your rental property is that it disqualifies you from making such elections. So to summarize, the decision to claim CCA does require thorough tax planning because it depends on how long you plan to hold the property, what's your risk tolerance, what's the investment returns that you're expecting. And that leads me to the last thing that you need to know. And that is you might just be focusing on the wrong thing. All these advanced strategies won't matter if you're not even getting your fundamentals right. And you keep making silly mistakes with your money without even realizing. Click here to learn the #1 TFSA mistake Canadians are making.